Greetings, everyone. Richard Solomon. Welcome to Taking Care of Business. Thank you for joining us today. We have a special program for all of those people who want to learn about tax, finance, accounting, bookkeeping, starting businesses, personal income tax, deductions, homeowners, non-homeowners. And the best person that I could find is a good friend of mine, Mike Locket. He's with Tax Saver Enterprise. You can check him out on the web at taxsaverenterprise.com. And if you have a pen handy, 631-231-4012. We'll give that information again throughout the show. But Mike, welcome to our show. Thank you for taking some time out of your very busy day to be with us. And,
Thanks a lot, Rich.
All right, so let's get started. There's a lot of tax out there. This is, when you think about it, it's kind of amazing how much tax there is between sales tax, property tax, transfer taxes, mortgage recording taxes, tax liens. There's a world of tax. And somehow, if you don't keep track of all the things that you're supposed to do, you can get really jammed up really bad. And then it takes a lot of undoing between professionals like yourself and possibly even attorneys and even, in very bad circumstances, criminal tax attorneys.
Yeah, that's true.
Because we've all seen that. So let's talk a little bit about on the personal side of tax. What are the kinds of forms people generally have to file? What do they need to know? And are there any myths that we need to spell, like, well, I don't make that much money, so I don't need to file anything kind of stuff?
Well, there are people that make a minimal amount of money, and they have forms for those people. It's called a 1040-EZ, and it's exactly as it says, EZ. It's for people that the income is low. They can really fill out those forms themselves. They put their name and address. And if they have just one job, they put in the information from the W-2. It's a very short form. It takes about 10 minutes to do. And then it can be electronically filed from your home computer. Then they have a more next complex return form is 1040A. That's for the moderate income individual. They earn between, let's say, $20,000 to $30,000. They may have a child that they support. You can use that form for that purpose. Then they have the long form, which is a 1040. That's for your homeowner. The 1040, you want to fill out a Schedule A. You can take a lot of deductions and things of that nature.
So let's talk a little bit about income and deductions and things like that. So as I understand it, income is anything coming in. So you have to report it all.
Yeah, anything.
Anything that comes in, for the most part, I guess, except for gifts and some other things and loans that aren't really income. But yeah, money that comes in is income.
Money that comes in from a job, from a side business, from if you work on the side cutting grass, bartering income. If you trade services for money or just services between yourselves. That's considered income. Gambling winnings is considered income. Believe it or not, a lot of people don't know, even if you have illegal money from drugs, things of that nature, that's income. Not that many people will report it, but it is income to you.
Right, but what's interesting about those cases is that not only will you be prosecuted for the underlying crime, but they will also prosecute for the tax-related consequences as well.
Absolutely.
In fact, that's what Al Capone
That's right.
went to jail for ultimately.
That's right.
Was what not reporting his whiskey sales or something.
That's tax evasion. If they can't get him on a murder charge or something that he may have done, then they'll get him for tax evasion because he's selling illegal products and he's not reporting that income. So it's easier for the government to prove that case than it is to prove some of his other illegal activities.
Well, what's interesting is on the LIU Post campus every year in August, they have a criminal tax summit. it's 8 hours, and a lot of people from the government are part of the instructional staff, and it's really scary. And you see people come out and they say, New York State's now really putting a tremendous emphasis on the following kinds of business or activities. And they will say things like, they now will look at almost any crime, and see if there's a tax-related component to it. So they say, all right, the guy on the street that sells the bootleg handbags?
Right.
So that's like a counterfeit, name brand product. So that's like, I guess, copyright or trademark infringement. And on top of that, they will prosecute you on top of that for sales tax.
Right. You're not paying, those people are not paying sales taxes on those sales. Again, it's an illegal activity because they're stealing from the original maker, and then thirdly, they're not reporting the sales to pay income tax on it. So that's threefold. They have three different charges that they could bring to that person.
So theoretically, I have a garage sale. Open up the garage, sell bicycles and little toys. I'm supposed to report all that, right?
That's income.
Yeah.
That's income to you. A lot of people don't do it because it's hard for the government to track those people. The government's not going to go to, they see a garage sale, they just don't have the personnel to go out and monitor everyone who's having a garage sale. They leave it up to you.
Right.
To report that income, to, put you on the honor system. But a lot of people just don't do it.
Well, what's interesting is, because I've dealt in the world of criminal tax work as an attorney to a very, very small extent, I learned a little piece of trivia that was very interesting, which is you will notice that they force a lot of criminal tax defendants to enter into plea deals in March, because they want is a flurry of press releases and people wearing orange jumpsuits and going to jail and things like that, so that in the news in early April, when people are starting to get all those returns put together, just to put a little chill on people, have second thoughts about,
Yes, it's a scare tactic used by the government. That's right, and they have several. If you ever check the IRS website, scams and fraud, not being in compliance. I myself, as a tax preparer, are held to high standards, and they make you stop and think twice about what you do on the tax return, because they will prosecute you. They will prosecute you, and you will spend time in jail.
Yeah. And there's a new nasty. I don't know. I know you know this one, but I don't know if the great listening audience that we have out there knows this. But did you know that if you owe New York State $25,000 or more in taxes and you don't pay them, they will revoke your New York State driver's license?
Driver's license, yes.
And that is harsh.
For not paying income taxes, they do it for child support. They will take your license, and then that's a hardship, because now you don't have a license, you can't drive, so you can't go to work.
To pay the money to pay for the taxes.
You're right. You can't go earn money to pay for those taxes that they're looking for. So it's tough, and you have to be careful. You have to be careful. Right.
So for all those people out there, don't be brazen. Talk to people like Mike. Get in compliance. You'll sleep better. You'll feel better. And all right. So there's the 1040A. There's the 1040EZ. We talked about those. There's the regular 1040. And you said the 1040 is more for homeowners, I guess, because they have deductions.
Right. The 1040A, most people fill out that form. They don't own a home. They may have a child, and they take what's called a standard deduction. The government allows you a certain amount of expenses for that you can take for the year without having to prove it. When you're a homeowner and you fill out Schedule A on the 1040, then you have things like real estate taxes, home mortgage interest expense, clothes for your job, union dues. I mean, there's a lot of deductions on there. The only difference is when you put those deductions down, just like we just spoke, you have to have proof.
Right. Now, I remember that somebody told me that not reporting income is a crime, whereas if you over-deduct, that's a matter of judgment. And as long as it's fairly reasonable, even if you're wrong, you won't go to jail. But if you don't report income, that's a problem.
Yeah, and that's a philosophy I use. If it's reasonable, then I won't be overly concerned. When it's unreasonable or you put numbers that are just too high as a deduction on a Schedule A, then you have something to be concerned about because their computers are getting smarter. The government computers are getting smarter. And they pick out these big numbers. So if you put false numbers on there that's too high, you're going to get audited. You're going to receive a letter in the mail, and then they're going to ask you for proof. If you can't show that proof, then they're going to disallow that deduction, and you're going to owe them money. You're right. You're not going to go to jail, but you're going to have to pay back. And let me tell you, they have heavy penalties and a lot of interest. So if you underpay them, overstate your expenses and it creates a liability to the government for, say, $1,000, by the time they get finished adding penalties and interest and negligence fees, it'll be almost $2,000.
One of the philosophies of a number of accountants that I personally know who are friends have always told me privately that they almost prefer that their clients overpay their taxes, that the government owes them money back, because you'd rather have in the balance of things that they owe you as opposed to you owe them.
Yeah, and it's maybe it sounds not fair, and some people don't want to hear that, but then you're always going to be on the safe side. Let's say you get audited. Now they go through everything and say, well, you know what? I didn't take enough deductions. I have checks here for more donations than I really made. I donated a car and I didn't put it on my tax return. So now, if you get audited and you add those things in, the government will actually owe you money.
Right.
So you need that's the best route to go.
Now, with sort of interesting, you talked a little about gambling income. I remember a long time ago hearing a story where a guy was like picking up all these receipts off the floor, like at Belmont, and I said, "What's that?" They said, "Oh, you need to have all the receipts for the losses to offset your gains."
Yeah. Yes, that's right. I tell my clients all the time. If you have gambling winnings, you say you win $10,000. If you don't have tickets to prove that let's say you spent $5,000 trying to win that 10, then you only have to pay tax on 5. But you better have the proof that you spent $5,000. So I tell that's right.
So how do you prove, like, if you're at a slot machine? Let's say I'm at a slot machine for a week, and I put in $5,000 worth of quarters, and I win $6,000. Now, right away, I'm pretty sure that when you win, they come out with all the tax forms, and they don't just hand you the money. I'm sure they do kind of stuff.
Right.
But how do you prove that you spent?
You know what? That's right. That's a problem. That's a problem with a slot machine. Yes, that's a problem with gambling.
So what do you do to prove what do you do? Subpoena the surveillance tapes?
Yeah, there really is no way. There's no way that you can prove that you put in. But once again, I go by the philosophy: if it's reasonable. If I won 10,000 and I put 5,000 in the machine, I might only put down that I put 3,000, just so the number is lower, so they don't question me. I might have to pay $100 more in tax, but that saves the aggravation of now you have to prove it. And for some reason, the government only deals with hard proof, which has to be written on paper.
Verifiable paper.
Verifiable paper, that's right. It has to be verifiable. And you can't verify the slot machine. You can't verify it if you're playing blackjack.
That's true.
You can't verify how much money you spent and there's no way to get that. So you have to be reasonable and just a little cautious.
And I guess
be aware.
I guess what we're going to have is, based upon our conversation here today, an army of people, receipt books, going to casinos saying, "Excuse me, Mr. Pit Boss,
Right? Yeah,
Mr. Coupier, Mr. Stickman, would you just sign here that says that you witnessed me lose $3,000?"
Yeah, that's right. That's right.
So anyway, this was the fastest first segment of radio. So for all of those listening, Richard Solomon, Taking Care of Business, tcbradio.com, and on YouTube with Mike Locket from TaxSaverEnterprise.com. We'll be right back. Don't go away. Welcome back, everybody. Richard Solomon, Taking Care of Business, talking to Mike Locket, TaxSaverEnterprise.com, because taxes are everywhere. They're brutal, they're unrelentless, and they know no boundaries. All right, so speaking of the pain and sorrow of taxes, let's talk real fast about audit. So let's say you got a little bit edgy. You didn't talk to someone like Mike, and you read some book that said deduct it all. You know, you deducted it all, and now you're there. And how do audits really work?
Well, first thing they're going to do, again, if that computer randomly picks your name, audits are done in certain ways. Either they'll randomly pick your name, or something will stand out on your return as erroneous. And the first thing they'll do is they'll send you a letter. There's such thing as a soft audit, where they'll send you a letter, and on the letter they're going to request certain pieces of information for deductions that you may have taken on your tax return. Things like mortgage interest or real estate taxes. You would have to send them your bank statement that you get from the bank at the end of the year, which proves that you paid mortgage interest and real estate taxes. Donations is a tough one, because IRS, sometimes they will accept a letter from the church, but then a lot of times they won't. Because let's face it, all ministers aren't all on the up and up. They may give you a letter. You go to your minister, you guys are good friends. He says, I need a letter for the IRS that says I donated $10,000. IRS may turn around and say, that's not good enough. We want to see canceled checks. Canceled checks is the best source for backup documentation. They can't dispute a canceled check.
That went through the federal banking system.
Right, that went through the federal banking system. It has to go through the bank.
So let's talk about check cashing facilities. In the seminars that I've been to in August each year at LIU Post, there is a whole big thing about the check cashing, and it looks like the IRS and other taxing authorities keep a very careful eye on all the people who go in and out of these places. Is that? I know that according to something I read today, I think it was like 11% of New Yorkers do not have a bank account at all. Yeah. Which is, that's troublesome. But,
that is. That's troublesome because they don't have a checking account. So you're right. They resort to the check cashing industry to cash these checks, and we issue checks. We print checks on site, and there's a number. And when you go into the check cashing places, they call and verify that those checks are good, that they're actually a bona fide income tax check, because it doesn't say United States Treasury. It'll just say from a bank.
Right.
And they take your photographs in the check cashing places now. You go in, you cash these checks. They take your photograph, your ID. In some instances, they'll ask for the tax return so they can verify that you filed a tax return and that's your refund. Because they, too, have to be careful. There's a lot of scams out there. People will make up checks, take them into check cash, and try to get money for them.
But one thing I've actually heard, and this was really brazen, this was one of the one of the government people were talking at the seminar that there are people out there who commit identity theft, file with the IRS fraudulent returns under fraudulent names to get a refund. And I'm like, wow, that's brazen.
That's brazen. There are people, they take you. I read these cases all the time. They take Social Security numbers for people who have died.
Yeah, especially if they died in childhood or you're very young. And and they extrapolate out as if they're still alive.
That's right. They take the Social Security number, the date of birth, and they file a tax return with it. They'll get the refund, sign it, cash it, and think nothing of it. But again, that's the road you don't want to go down.
Oh yeah, no, we have to have some fun in a subject like taxes to talk about. So what are the red flags that trigger audits that you seem to see all the time? You kind of like touched upon, like maybe donations is a red flag, or
donations is a big one. Again, if the number is too large, reasonable. Once again, you have to always go back. Reasonable. If I earn $40,000 a year and I say I donated $1,500, even if I don't have proof, that's a reasonable amount of money to donate. But and they won't question that. But if I make $40,000, I say I donated $10,000, you're going to get pulled. You're going to get flagged.
Well, I've also heard from people, I guess, the usual cocktail comments that, let's say you live in a fancy zip code, but you don't report that much money. Isn't that there's sort of like, well, how could you afford to live in Beverly Hills, for example? Wait, you're living on Beverly Hills on minimum wage.
Yes, that's right. That will pull. That's rare, but it happens, and they do. I've seen them before. So let us ask people, well, how did you afford that house if you only reported $10,000 in income and you living in a house that costs $500,000? They want to know. And if they don't, then when they start to investigate, they will start to investigate. When they start investigating, most times out of 10, they're going to come up with something, either illegal activity or whatever it may be. Hopefully, you don't fall into that category and you just hit the lottery or you borrowed money from a rich relative, but you better be able to prove it.
How much are audits triggered by just people just not either using software or spreadsheets or organizing their information? And
audits are done, like I said, they're picked random. The computers are designed to pick a person's name out randomly. Let's say if the person is a single parent and her last name or his last name is different from the child's last name that's on a tax return. That's a reason the computer might say, you know what, let's check this out. And the computer just pulls the return and says, okay, let's verify that that's his child. And that's how they catch a lot of people. And I've seen that time and time again. A lot of people claiming other people's kids. And let me tell you, they do it. People will sell their kids during tax season time, and they'll use other people's kids. So IRS says, okay, if the name doesn't match, then we're gonna pull that return, and we're gonna send them a letter and say, prove that you took care of this child. Prove that the child went to school from your house.
That's really tough.
And that's how it's done.
What is the deduction for children generally?
Well, there's a thing called child tax credit. It's $1,000. They always say they're going to change it, but they haven't. You get $1,000 child tax credit, and then you get the earned income credit. Whereas if your income is between a certain level, not more than, if you have one child, it's like $38,000. If you're in $38,000 or below when you have one child, the government actually gives you money back. Okay. They give you extra money. That's called an earned income credit. If you have two children, the government will give you, I think it's like $5,000. And it's based on your income.
Okay.
If you make $20,000, the government, and you have 2 kids, the government may say, here, we're going to give you, because you're a single parent, we're going to actually give you money to help you along in your refund. So they'll give you up to $4,000. If you have 3 kids, they'll give you up to $6,000.
So, okay, so as I understand it, children are children until they're 18.
Until they're 18 years old. Even after they're 18, if they stay in school, then it's up until 23.
That was my question. So it's the hope of many parents that they can send their kids to college.
Right.
Now, how does deductions work with college kids? Like, what if you're not really paying for the college and the kid's working, or you got student loans? How does deductions work for children versus college children?
Well, usually if your child is going to college, he's not earning that much money. He gets a summer job. He makes $2,000 or $3,000. He probably most likely doesn't have a tax return to file. Or if they took out a little tax out of his check, he's one that can do the 1040 EZ that I spoke about earlier. He puts his name and address, puts the one little, how much money he made in that one little job, and they may send him back $100 or $200. But the parent can claim, there's 2 types of credits. There's American Opportunity Credit, and there's a Lifetime Credit. American Opportunity Credit, that gives you $2,500. It gives you a $2,500. $1,000 is refundable. $1,500 is non-refundable. It gets a little complex, but to simplify things, they'll give you up to $2,500, and the Lifetime Credit will give you up to $2,000 deduction.
All right, wait. What's the difference between a deduction and a tax credit?
Okay. A credit is a credit against taxes that you owe. Let's say you earn $40,000 and your tax liability is $4,000.
Right.
Then you get a credit against that tax. For the opportunity credit, they'll give you $1,500. So instead of owing $4,000,
you owe $2,500.
You owe $2,500.
Right.
And then they'll give you an additional $1,000, which is dollar for dollar. They actually give you $1,000.
Okay. Now, how much college and post-college education is deductible? Like, let's say I go for 3 PhDs or something like that. How much of that? I'm the perpetual student. I can't get that major I really like. So, philosophy didn't work out. Now I'm trying the history of art. Now I'm trying the history of science, and it's just not working. But at PhDs, at what point are you allowed to have deductions? What you take for themselves, and then what becomes what they call a hobby? Well, not that
No, it's not, hobby that's different. That's when you're in the business. But as far as college kids, you can be a professional student. That's why they have 2 different types of credits. The American Opportunity Credit, you can only take up to 4 years. After 4 years, you can't take that credit anymore. The government's not going to give you $2,500 every single year for the rest of your life. But they have the Lifetime Credit. And the Lifetime Credit, you can take as long as you go to school. So every year, you can take $2,000. Well, it's 20% of whatever you spend for school.
All right.
So if you spend $10,000, then you can take a $2,000 deduction.
What about people like yourself and myself who have been out of the school system for a while? But let's say we want to go back. Are we eligible for this?
You would take the Lifetime Credit, because hopefully you probably already took the affordable credit. Back then, before it was the affordable credit, the American Opportunity Credit, it used to be the Hope Credit. And that was the same. It was the same rules. You could, after 4 years, you can't take the Hope Credit. So when you go back a few years ago, let's say 10 years, it was a Hope Credit. If you took that for 4 years, then you can't take it anymore. Now it's called the American Opportunity Credit. But you can still, for us, guys like us, we can still take the lifetime credit. So if I went back to school and I spent $10,000 in tuition, then I'll get a $2,000 deduction on my tax return, which would increase my refund.
Okay. All right. So let's move on. We're blazing through here. Let's talk a little bit about business. All right. I know that you have a real specialty with businesses, and there's a tremendous need out there for people who are starting businesses, especially small businesses, for a lot of guidance. As we were talking sort of in pre-production, it's always been my observation that people start businesses, they make lots and lots of mistakes. They pay some heavy-duty prices, both emotionally, financially, time-wise. And after a number of years of business, then they become really good at it. But nobody really teaches you the important things, all the rules, the regulations, the permits you need, the licenses, negotiating leases, what's a good deal, what's not a good deal, regulatory issues, the Affordable Health Care Act, which we should probably get into a little bit too. When you start a business, obviously my advice to everybody is you need a good accountant. You can't just start a business without a good accountant.
You have to have a good accountant. You should have a good lawyer on the side, at least someone that you can go to, because he can get you your corporation. But for a small business, for most people out there who want to start a small business, and I suggest that you go to the county clerk. First, you have to come up with your business name. You have to come up with your business name, what it is you're going to do. And then you go to the county clerk. You go to the county clerk, you pay a small fee. I think in Suffolk County it's $35. I think in the city it's along the same lines, $35, $40. And you do a name search to make sure no one else has your name. You pay the fee. You fill out the forms. They will notarize the form right then and there. And then after you fill out that form and you register your business, now you're in business. You can do business, but you need the accountant. Unless you're, you have to be computer savvy and know the tax law. And that's just not so. After you get your business started from the county clerk, you get your business name. Then you have to get an employer identification number. That's a number just like your Social Security, but you should never use your Social Security number for your business. The business should have its own Social Security number, which we call an EIN number, which is an employer identification number. You get that number, and then you can go to the bank. You open up an account in that name. One important thing, if you're going to do a sales business, then you have to get a certificate of authority from New York State. In other words, to collect sales tax. If it's a non-sales tax business, if it's not a resale business, then you don't have to do that. But if you're a reseller of some type of product, then that's an additional form that you have to have. And again, you need an accountant. You have to file to New York State. You get that. Because without that, the penalties are stiff. When I say stiff, $1,000 a day.
Wow.
For collecting sales tax. If you collect sales tax without a certificate of authority, the penalties are heavy, and you'll serve some jail time.
And not only that, just for the people out there who don't know this, you cannot escape personal liability because sales taxes, you're considered a trustee of that money.
That's right. You're a trustee for the state.
Right? You're the designated agent for the state. So they expect you to keep their money safe.
That's right, yeah, you have a lot of business people, they don't like that. They don't like that. I had a client once tell me, how come the state doesn't collect their own sales tax? Well, they can't send someone to every single business in the United States to collect the sales tax from them. They trust it to you, and you have to do it as a citizen, as a U.S. citizen. You have to do it.
This tape is going to be on YouTube. I'm sure 100 years from now, the government will figure out a way that when you buy something online, that the tax is remitted straight to somebody.
Years ago, when you buy stuff online, you didn't have to pay the sales taxes, and you didn't have to report that income. They've since come up with a system where all transactions and these companies like Amazon and all, they're required now to send to the government, to tell the government, this business with this tax ID number ran this amount of money in a credit card, so that you can't get away without paying taxes.
All right, speaking of that, we'll take a quick break here. This is Richard Solomon. The show is Taking Care of Business. I am with Mike Locket, TaxSaverEnterprise.com, 631-231-4012. We'll be right back. Richard Solomon here. Welcome back. This is Taking Care of Business. If you'd like to call us at Taking Care of Business, you can call us at the radio station during business hours, 516-299-2683. We are on the web. Our email is tcbradio.wcwp at yahoo.com. And you can catch us on YouTube. We have a whole channel. We have over 100 episodes up there. We have tens of thousands of hits. And it's really, really nice. We have a lot of great feedback. You can find us on YouTube if you put in the search term TCBRadioWCWP, all is one word. You'll see a little picture of a microphone in front of a soundboard. That's actually our real microphone and soundboard at the station. And you can see all our episodes. We've had all kinds of great feedback, comments, people calling. Some of the great guests that we've had have been suggested by our audience. So keep it coming. All right, so today, in case you're joining us at this part of the show, we are with Mike Locket. Now, Mike, I know Mike. We actually do things professionally together because lawyers and accountants really need each other. A lot of times, lawyers need experts in different fields, either for advice or for trial testimony. So Mike is one of those people that I'll call and I'll say, hey, Mike, I got this, and then we'll talk about it. So let's talk now. We talked a whole bunch in the first segment about personal income tax, tax forms, deductions, audits, the dreaded audit, criminal tax issues. We start a little bit in segment 2 towards the middle end about, just starting a business and things like that. But now let's talk a bit about sort of one of the new wrinkles into the system, which is the Affordable Care Act. Because a lot of people don't really know how it affects them. The rules are kind of changing, I guess. I hear all kinds of things from all kinds of people in hallways of courthouses. I had coverage. I don't have coverage. I need to get coverage. I need, this is a problem. How does all that work right now?
Well, the Affordable Care Act, if you don't know, it's a new law that was put in place, and it started last year, where everyone must have, I repeat, everyone must have health coverage from an insurance company, whether it be Empire, Blue Cross, Blue Shield, whether it be Aetna, whether it be Medicaid, Medicare, but not some of these. It has to be a bona fide insurance company.
So I assume there's a big list there somewhere.
Yeah, there's a huge list, and it's also called the marketplace. You can go to the marketplace. There's many insurance companies, and it's expanding. But the new law is, if you don't, that's the most important thing. If you have coverage on your job, then you're okay. You don't have to worry about it. Job pays for insurance, and it's reported on your tax return. Simply check a box that says, yes, I'm covered on my job, and you're okay. And it's for the people that don't have coverage. That's called the health care responsibility. It's a shared responsibility that everyone or anyone who is not covered, there's a penalty. And the penalties can add up. It's called a shared responsibility penalty, and the maximum is $285 on your tax return. Either that'll increase your refund or increase the amount you have to pay if you owe. There are exemptions from that if your income is very low, which is below the poverty line, as they call it. If it's below the poverty line, then you don't have to pay that penalty. But let me say this. It's $285. It's $95 for an adult, $49 for a child. Next year, it's going up to $325 in 2015. And then in 2016, it's going up to $695. So if you didn't have coverage this year and you said, I'd rather pay, I get people all the time say, I'll pay them the $85 or I'll pay them the $100. Well, it's going to get steeper. The penalty is going to get higher. So it pays. And you need health insurance.
So let's say this. You're now a business owner. How many people do you need to have as employees before you have to give them health insurance? And under what circumstances between part-time, full-time, related businesses is all that stuff triggered? Well,
when the government does do one good thing. If you have less than 25 employees, the government, and they're full-time, you have some full-time and some part-time, the government actually gives you credit to the company, whether it be a small business or even some of the large corporations. But they'll give you a credit for issuing insurance or allowing the employees to be covered under a plan. So you may pay $1,000 for, let's say, 2 employees, 2 or 3 of your employees. $1,000 may cover their plan, because plans usually about anywhere from $250, $350, $500 a month. But then the government will give you back part of that money that you're paying out. So if you spend $1,000, the government may give you back $200.
Okay.
So, I mean, it is a good thing. Everyone needs insurance. Everyone needs insurance. How do you figure out if you owe money? There's a form that you fill out. They have an 8965, and you fill that out, and that will tell you if you owe, if you have to pay that shared responsibility penalty. But for self-employed, such as people like yourself and myself, you can always get a premium tax credit. Now, if you go through the marketplace, the government actually pays part of that insurance for you. So that's supposedly one of the benefits of the plan. The government will pay, say, $250, and then they'll say you have to pay $250. That's better than paying $500. But
yeah.
They base that upon your income. So every year when you send your tax return in, they'll say, okay, we paid too much on your behalf, or we didn't pay enough on your behalf. If they paid too much on your behalf, then you have to pay back the overpayment that they paid on your behalf. If they didn't pay enough, then you get a refund. And that all fluctuates with your income. It changes. It can change every year. When I sign up for the plan, and I earn $30,000, but at the end of the year, I only really earn $20,000. Then they'll owe me money back because they didn't pay enough on my behalf. So they'll give me a credit on my tax return. It's a very complex law. Everything is based on your income, how much you make. It changes, and you have to constantly notify the government. Not constantly, but each year you have to notify, and in between the year.
Well, that's constant.
That's constant. That's right. That's constant because you have to let them know if there's a change in circumstance. If you lose your job, then you say, well, I don't have enough to make that payment. Then you're right. Then they'll pay more on your behalf, or at the end of the year when you file your tax return, they'll say, oh, we didn't pay enough for you, so we're going to give it back to you in a refund on your tax return.
So let's go forward now with payroll tax. If I own a business, I have a couple of employees, and let's talk a little bit about the difference between an employee, a W-2 employee, and an independent contractor, a 1099, because there's a lot of litigation over that. So let's talk a little bit about that, and then what are the taxes that you're responsible for when it comes to payroll. You just can't give people just a check. Like you pay someone $30,000, you're not giving them $30,000. You're giving them something else.
Right. Yeah. Well, yeah. Again, just like the sales tax, payroll taxes. When you have an employee, you're paying them a salary. Out of that salary, you're taking out federal tax and Social Security tax, Medicare tax, state tax. That's why a lot of people look at their check. They say, I make $500 a week, but they only come home with $300 because the employer takes out a portion of that money, and they have to send it over to the government. Once again, if they don't send it to the government, then they are personally responsible to pay back that money. And that's a scary part. When you're an employer and you have to withhold those taxes. That's why a lot of employers will give you a 1099. So now when they give you a 1099, then you have to pay your own taxes. So that eliminates them having to collect that money from you and send it to the government. They give you a 1099. You put that on your tax return, and you have to pay your own Social Security and Medicare tax and state tax. You have to send it into the government yourself. So it's not a good position to be in because, a lot of people don't want to be in a position where they have to send the government money, because a lot of times when they get to 1099 at the end of the year, they say, well, I don't have any money left.
I spent it.
I spent the money, right? They spent the money. But you got to pay. You have to pay that. You have to pay that tax yourself. So, if you're working for an employer, you tell them, look, I want a W-2, if it's at all possible.
Why does the government seem to push very hard for people to be designated as W-2 employees as opposed to 1099s?
Well, when they're W-2, the government is almost assured to get their money. And keep in mind, the employer, whether it be a W-2 or 1099, they have to notify the government. They have to notify the government, I paid Rich $50,000. I took out this much money from his check. Here, I sent it to you.
Well, it's probably easier for the employer to say, look, Rich was a 1099. I gave him 50. So call him.
Right. That's right. It's easier for the employee to do that. But you got to be careful there, too, because is he really a 1099 independent contractor? Or is he working? It's like you're a lawyer, you work for yourself, so you may get 1099s from different clients because you did work for them, and they paid you. They paid you for their service, so they're going to take that deduction if they can on their tax return.
Now that's it. Let's say I have 300 clients, right? Yeah, whatever. But let's say, for example, I have just one client because the client just thinks I do the greatest work in the world.
Right.
And even though I have my own office and I make my own hours,
right?
Where's the line between you're really like an employee as opposed to a 1099?
You're a 1099. You have your own office. You make your own hours. That's the difference.
That's the test?
That's the difference. If you're an employee, if the employer makes your hours, tells you when you have to be at work, and then you have to be there at a certain time, and you're going to earn a certain wage, that's an employee.
Okay.
When you're required to be at a certain place at a certain time, and you're under his guidance for those 8 hours for the day, whereas you are an independent, so you're going to get a 1099. You can't confuse the two.
Okay, let's go off topic for a second because we only have 4 minutes. And I've seen a big trend in litigation on failed to pay minimum wage, failed to pay something called spread of hours, and failure to pay overtime.
Oh, yes. I just had one the other day.
Yeah, they seem to be popping up all over the place. In 2 minutes or less, could you give a thumbnail sketch for what's out there?
A lot of employers try to get away with that. where they don't pay over 40 hours. Over 40 hours is time and a half. But a lot of employers, well, you'll work 48 hours, and they'll just pay you 48 hours straight time. No. If you take them to court, the court will overturn that and say, you owe this person, for those 8 hours, you owe them that time and a half. And they will make you pay that time and a half back. I don't care if it's for a year or 2 years. I've had someone came in those days, for 6 years, they worked, and they never got paid the time and a half. They took the employer to court. The court made them go back and pay them. It was like $20,000 in back pay.
And it's a little brutal because the employers are expected to keep all the time records.
That's right.
And if you don't have time records, that's all a big problem.
Yes.
And there's something like if you work more than 10 hours, there's like a forced hour extra you're supposed to pay called the spread of hours, which I didn't learn about until one of my clients did that.
Yeah.
And then you can't say that somebody's like a manager or something like that. You can't just give titles, and you can't sort of say, well, that's your salary, or you set there's a lot of rules out there. And I see that as a real emerging trend.
It's a problem. It's a problem because a lot of employers do it, and they get away with it. Most of them get away with it because a lot of people don't say anything because, you know what? They're glad they have a job.
Right, it's a tough job market out there.
It's a tough job market. They're glad they have a job, so nobody says anything. But the employer's dead wrong, and they know it.
All right, we only have a minute left. So for all that time that you spent with us, share with us your expertise, what you do, mostly what do you focus on in your practice?
We specialize in income taxation, small business, startups, corporations, which we didn't get to touch too much on. That you have to file to New York State to get limited liability. That's one reason you want to be a corporation, to get limited liability. But you file to New York State, it's a little bit more costly. If you get an attorney to do it, they'll probably charge you about $1,000.
I charge much less than that. But bum.
Yes, some attorneys will charge you $1,000 to do that. Some less, of course. I myself charge $500 to do it, but I also get them their employer identification number, the sales tax certificate if they need it that I spoke of earlier, everything that they need to get their business up and running.
All right.
That's the difference. That's what you need an accountant for.
All right. So with that, taxsaverenterprise.com. Richard Solomon thanking Mike Locket for spending his time, his very precious time. Obviously, we're doing this interview not during tax season because we would never be able to get the call in.
Well, yes. It's a hectic time of the year.
Oh, it is. The tidal wave of paper is just unbelievable. So for all of those out there, have a great week. We'll see you next week. Be safe. And if you need any information on a show, either this one or a past show or a future show, call us, email us. We love having tremendous interaction with our audience. For now, thanks and see you next.